what are the various tax saving instrument investment opportunities available, and declaring the incomes, declaring the investment, and what are the areas you need to be very careful about. Now, firstly, who should be planning for their investment and its declaration? Firstly, we have to understand that in majority, the old tax regime allows all the investment declarations. Under the new tax regime, very less opportunities are there for investment and its declaration. Now, even if you are opting for older tax regime, there are certain conditions you need to fulfill so that income tax declaration becomes absolutely necessary for you. For example, if one person's salary income or total income is more than 5 lakh rupees, in that case, that person is required to plan for investment and its declaration. Why? Because as per the Income Tax Act, if you are opting for the old tax regime, in that case, if your income is not crossing 5 lakh rupees, total income is not crossing 5 lakh rupees, you are not supposed to pay any taxes, right? Even though you will be required to file your income tax return, you are not supposed to pay any income taxes. Therefore, if you see that your income is no more than 5 lakh rupees, uh, income tax declaration loses some of its relevance to you. Secondly, if your income is more than 5 lakh rupees and you are opting for old tax regime, in that case, most definitely you should be planning for investment and its declaration. Now, what are the items that can be declared, right? We are going to take a look at those options in the later part of this webinar. But one thing I would like to put forward from this point of time, that whenever you are making this declaration, please do not consider only the tax saving part. You can also consider declaring other incomes as well. Now, let me tell you one example. Most of us have salary income, definitely. Apart from salary income, there is some investment income coming in our hand as well. For example, we can open up FDs, right? We can invest in shares of Indian companies, right? So from these investments, we get certain amount of money in our bank account. Now, all this amount that we are receiving falls under the ambit of income taxes. That means whenever you are earning this amount, you are supposed to pay certain amount of taxes based on your slabs. Now, if you are declaring all these incomes, FD incomes, dividend incomes, etc., in your income tax return, and you are supposed to pay an amount of taxes, then you are supposed to pay some amount of advance taxes in case the total tax liability after considering TDS and everything is more than 10,000 rupees. In most of the cases, if we are in employment for quite a long period of time, we tend to make multiple FDs, we tend to make multiple investment in shares, which can give us a good amount of return, and in turn I will be required to pay a good amount of tax as well. And if I am not paying advance taxes on that, again a certain amount of interest will be levied upon me. The tax amount I have to pay in any case, but interest on default of not paying advance taxes gets triggered. And if we are declaring those incomes, at least on a presumptive basis, we can take an assumption that during the year I will be having 1 lakh rupees of FD income, I will be having 5,000, 50,000 rupees of dividend income, etc., etc. And if we can declare that to our employer, they will take that additional income into consideration and compute the taxes and withhold the taxes accordingly, which can save me a lot of pain at the time of filing the income tax return. Therefore, consider not only submitting investment declaration, consider also declaring the incomes as well. Now, why should one person be investing? There are multiple good reasons you should be investing. For example, uh, you can save for the future, right? You can save the taxes. That is a very good reason for making those investments. Creating wealth and assets. Again, that's a very good reason for making those investments. Now, what are certain expenses that can be claimed for tax saving purposes? First and foremost, house rent allowance. Now, house rent allowance, if you are staying in a rented place for your employment purpose and your salary does have a house rent allowance component, in that case, you are supposed to get house rent allowance deduction. But there are certain aspects of HRA you should be keeping in mind. Number one, not the amount of rent that you are paying. It cannot be claimed as deduction in its entirety. As per the income tax rule, we have to look for three figures to get to know about my house rent allowance deduction. Now, what are these three figures? Number one, 40% or 50% of the basic salary. Now, if your salary has DA component in it, dearness allowance component in it, in that case, that can also be added to basic. Now, 40% or 50%, that actually depends upon the city that you are living. If you are living in a metro city, namely Delhi, Mumbai, Kolkata, and Chennai, for these purposes, these four are only other metro cities. All the other cities are non-metro cities. Right? If you are staying in Delhi, Mumbai, Kolkata, or Chennai, then 40%, or sorry, 50% of the basic needs to be taken into consideration. In any other city, for example, Bangalore or Pune, 40% of the basic needs to be seen. Second is the actual amount of HRA that you are receiving. And final point is actual rent that you are paying minus 10% of basic plus DA if it is applicable. Right? Out of these three figures, whichever figure is the lesser, that will be given to you as house rent allowance, right? Therefore, if you are under the notion that amount of rent, the actual amount of rent that I am paying can be taken as house rent allowance deduction, that is not correct. Further, HRA is only available under the old tax regime. Second tax saving expense is your leave travel allowance. Now, leave travel allowance, to sum it up really quickly, if you are traveling within India, in that case, train fare or air fare can be given to you as deduction from your salary income. However, to get this, you have to adhere to certain conditions as well. Firstly, a LTA, leave travel allowance, is given to you only twice in a block of 4 calendar years. Now, the recent calendar year block has started from 2022, right? So we are at present on second year of that block. Secondly, only to and fro travel expenses can be deducted. And when I say travel expenses, I only mean either train fare or flight fare. All the other expenses cannot be taken as deduction. For example, cab expenses or meal expenses, those are not deductible at all. If you are thinking hotel staying expenses, that also cannot be taken as deduction. Only to and fro expenses for train or economic class flight is deductible. Thirdly, you can travel within any place of India to claim this with your dependent spouse, with your children. However, if you are traveling beyond India, maybe Bali or Germany or any place which is outside India, it is not deductible. Also, it is allowed only under the old tax regime. There are certain other expenses as well which can be taken as deduction. For example, petrol expenses and driver expenses for motor car that uh, actually can be deducted because once the lockdown has been lifted, people are coming to office much more regularly, right? So now this has been uh, gained a little bit more popularity, right? Also, depending on the engine size of the car, the actual expenses deduction can vary. Furthermore, uh, food coupon allowance, food coupon allowance. If your employer is giving you food coupons, in that case, excuse me, that can be deducted as well. Maximum amount that can be claimed is 50 rupees per meal for maximum of two meals for 22 working days. Now, this deduction, food coupon allowance, is available under old tax regime only. Petrol expenses, driver expenses, those amount can be availed under new tax regime as well as old tax regime. Now, interest on home loan. Interest on home loan can be taken as deduction as well. However, there are certain conditions attached to it as well. Firstly, once the house is completed and you are in possession of that house, then only this amount of interest that you have actually paid can be taken as deduction, right? For self-occupied property, maximum 2 lakh rupees of deduction per year can be claimed. And finally, uh, the house can be taken as self-occupied house property if your parents are staying in that house as well, or any dependent of you are staying in that house as well. Right. Now, many of us actually acquire a house property or flat while it is under construction. And while the house is under construction, you need to pay some amount of EMI as well. So, what will happen to the interest on those EMIs that you have paid during the house was under construction? In this case, income tax allows you to take the interest deduction for the construction period as well. However, it does not give you the opportunity to deduct the entire sum in one go. Till the house was under construction, you need to accumulate that interest, and over a period of 5 years, after the house is completed and you are in possession of that house, you can claim equal amount of deduction each year. Now let's try to understand this situation with an example. Let's say you have purchased the house in 2020, right? You have taken the home loan and purchased the house, right? For 2020, the house was under construction. 2021, still the house was under construction. In 2022, the house got completed and you got the possession. In 2020, let's assume you have paid 1 lakh rupees. 2021 again, let's assume you have paid 1 lakh rupees. In 2022, in the year the house is completed, you have paid, let's say, 1 lakh 50,000 rupees. So, in the year 2022, you will most definitely be getting 1,50,000 rupees of deduction of interest because you actually have paid this amount in this year. Furthermore, total accumulated interest for the construction period is 2 lakh rupees. That will be given to you over a period of 5 years in equal installment, which will give you 40,000 rupees. Therefore, in the year 2022, you will be claiming 1,50,000 rupees for that year plus 40,000 rupees of interest for interest on construction period. So, in total, your interest claim will be 1,90,000 rupees. Now, one point you have to keep in mind that maximum deduction for self-occupied house property cannot be more than 2 lakh rupees a year. So what will happen if the amount is more than 2 lakh rupees? In this scenario, 40,000 rupees was under construction period interest. And let's assume in the year 2022, in the year you have got the possession of the house, you have paid 1 lakh 80,000 rupees, right? In total, you are making a claim of 2 lakh 20,000 rupees, which is more than 2 lakh rupees. Therefore, even though the claim for the year is 2 lakh 20,000 rupees, you will only be getting deduction of 2 lakh rupees. Remaining 20,000 rupees will not be given to you as deduction and it will go to waste. Now there are a couple areas that there are a couple question that comes up in the minds of people. Firstly, can I claim HRA and home loan interest in the same return? Now, this is a very interesting question because you can certainly do that if this situation applicable for you. For example, you your hometown is in Delhi, right? But for your employment purpose, you have relocated to Bangalore. Now, in your hometown of Delhi, you have purchased a flat, and in that flat, your parents are staying, who are dependent upon you. As I have said earlier, self-occupied property can also be considered as self-occupied in case your dependent parents are staying. If your dependents are staying. Since my parents are dependent parents and they are staying in the house property that I have taken on loan, I can claim home loan interest benefit. Furthermore, I'm staying in Bangalore. I'm paying rent for my employment purpose because my office is in Bangalore. In that case, I'm also eligible to get house rent allowance deduction. If this scenario is applicable for you, then most definitely, you can claim uh, HRA benefit as well as home loan interest benefit. The second question is, can this home loan be taken into consideration in case the loan is co-borrowed? Now, if the house property taken by you is under both the spouses' name, let's assume the house property that is purchased, the flat that is purchased by spouses, husband and wife, right? The loan amount is also taken by both the spouses, right? They are the co-borrowers. In that case, the amount of interest and the amount of principal, they will be split between both the spouses in its equality, and both will be getting the benefit of deduction of 2 lakh rupees separately, right? So if during the year the amount of interest paid is 3 lakh rupees, then both the spouses will be able to claim 1 lakh 50,000 rupees in their hands respectively. The same situation will be applicable for principal repayment as well. There is another section that talks about deduction, that is section 80 EEA. Now, section 80 EEA has certain stringent conditions attached to it before you can claim it, before you can make the cut. For example, the loan needs to be taken from a bank. The loan needs to be sanctioned between 1st of April 2019 and 31st of March 2022. The stamp value, the stamp duty value, the registration value of the property should not be more than 45 lakh rupees, and the loan should be taken to purchase first property of the person. Now, there are certain conditions we have to consider for purchase of first property clause. Sometimes it may so happen that ancestral property is transferred to the person's name, and that person is taking up a loan to purchase a new house property. In that case, since there is already a house property registered in the name of that person, 80 EA benefit will not be available for you. Now, we have to remember one thing, that is section 80 EEA benefit is over and above section 24 benefit, the general section for allowing you home loans interest, right? In any case, if you have taken a loan, in any case, you will be getting the deduction under section 24B. Section 80 EA only talks about giving you additional benefit if you are fulfilling certain conditions. If you are not fulfilling those conditions, don't be afraid, because you can still claim the interest deduction under section 24B. Again, this deduction is available only under the old tax regime. Excuse me. Now, there are other investment opportunities options under 80C. That is the most talked about section for tax saving. For example, you can invest in PF. Uh, it can be employer provident fund, it can be public provident fund, it can be voluntary provident fund, and you can take the deduction under 80C. Tuition fee of children. So if your children are going to school or university or colleges, in that case, any amount you are paying for their admission and actual education fees can be taken as deductions. One thing you have to remember, that developmental fees or donation, whatever it may be, which is other than the admission fees and actual education fees, cannot be taken as deduction. Life insurance premium, if you are again paying a premium to keep a policy in force, in that case, you can claim the premium paid as deduction. Principal on home loan. Now, if you have taken a home loan, obviously you can claim the amount of interest under section 24B that we have discussed earlier. The principal repayment can be claimed under 80C as well. Furthermore, in the year of purchase, in the year of registration, the registration fees can also be taken as deduction under 80C. Investment in ELSS, that is equity linked savings scheme, that is also specifically mentioned under 80C. Now, if you are making investment in ELSS mutual fund, you can take that amount of investment as deduction. However, if you are making the investment in ELSS, the amount needs to be locked for a period of 3 years. Furthermore, you can invest the amount through SIP or any lump sum investment amount. Also, since these are equity oriented mutual fund, all the benefits of capital gains on equity and equity oriented mutual fund gets translated to ELSS mutual fund as well. However, one thing you should be keeping in mind, that it has a lock-in period of 3 years, right? Now, tax saver FD is also a good option to save some amount of taxes. It has a lock-in period of 5 years, and whatever amount of interest you are earning on tax saving FD, that becomes taxable in your hand. Other investment options are investing in SSY, Sukanya Samriddhi Yojana. Uh, you can invest in this SSY plan once the daughter is born, and you can invest in SSY till she attains majority. Once she attains the majority, you can withdraw the money and fund her further education using that amount. Uh, NSC and post office deposit schemes are excellent tax saving opportunity for you if you want to nullify the risk of all the other tax saving options. Now let's talk about other investment option. For example, pension plans. Now, if you are investing the money in pension plan, in that case, uh, you can save the amount of taxes. However, the deduction for pension plan, that is 80CCC, that falls under the category of section 80C, that is limit of 1.5 lakh rupees. Now let's talk about national pension scheme. Now in national pension scheme, you can get benefit in three ways, right? Number one, if your ATC limit is not fulfilled, right? The limit for ATC is 1.5 lakh rupees. If it is not yet filled and you are making the investment in NPS, then you can get the deduction under section 80C to the extent of not fulfilling the ATC limit of 1.5 lakh rupees. Now, if you are making the investment but not taking its benefit under 80C, you can claim the amount invested in NPS in another different section than 80C, and that is 80CCD 1B. Now, if you are foregoing to claim deduction under 80C, you can get a deduction of maximum up to 50,000 rupees over and above 80C limit of 1,50,000 rupees. So, if you have many tax saving instrument, for example, you have LIC, you have ELSS, PF, etc., which is eating up your 80C limit, in that case, you can consider investing in national pension scheme and you can get a further deduction of 50,000 rupees. And if you belong in the highest marginal slab rate of 30% under the old tax scheme, you can save 15,000 rupees of taxes just by investing in NPS. Furthermore, if you are making the investment in NPS, then you can invest in NPS through your employer as well. Now, this contribution to national pension scheme through employer, excuse me, can be, the benefit of it can be taken under both the tax regime, right? Employer contribution in MPS is available under both the tax regime. It is available under the new tax regime, it is available under the old tax regime as well. However, maximum you can invest is 10% of your salary, and salary in this context is basic salary plus dearness allowance if it is applicable. Now, if you are opening up a NPS account, in that same account, the amount can be contributed. Now, 80C is a very well-known section, but there are certain other sections which can give you benefit of tax saving. For example, 80D, that is medical insurance premium paid. Now, if you are not a senior citizen person, in that case, premium up to 25,000 rupees can be taken as deduction. If the actual premium is more than 25,000 rupees, it will be limited to 25,000 rupees. If it is lesser than 25, then the actual amount will be given to you as deduction. If your dependent parents are not senior citizen, then you will get another band of 25,000 rupees for their medical insurance premium as well. If your parents are senior citizen, in that case, this 25,000 rupees limit gets extended to 50,000 rupees. Now, there are certain instances wherein parents being senior citizen, they cannot be covered under any medical insurance, right? There are certain instances. In that case, if parents are senior citizen and they are not covered under any medical insurance policy at all, then you can claim medical expenses up to 50,000 rupees. Now, let me reiterate this very clearly. If they are not covered under any medical insurance, then only medical expenses can be claimed as deduction. If they are covered by any group medical insurance policy, if they are covered by their previous employer, if they are covered under any medical insurance policy, but no claim has been entertained due to the fact the specific diseases are not covered under that medical insurance. Even in these cases, medical expenses cannot be claimed. Why? Because they, even though you are spending money for their medical expenses, they are covered under a particular medical insurance policy. Therefore, you have to be very, very careful about this. Now, there are other sections of deduction, for example, 80TD. If any dependent of the person is differently abled, in that case, depending on the disability limit, a blanket deduction of 75,000 rupees or 1,25,000 rupees is allowed as deduction. If the dependent person or the person himself or herself is diagnosed with specific diseases, then maximum 40,000 rupees can be taken as deduction. If they are senior citizen, in that case 1 lakh rupees can be taken as deduction at maximum. Now, if, for example, for 80DDB purposes, certain diseases are Parkinson's disease, any motor neuron disease, certain types of cancer, AIDS, etc., etc. Now, if the assessee himself or herself is differently abled, in that case, depending on the disability limit, 75,000 rupees or 1,25,000 rupees of blanket deduction is extended. Interest on education loan. Now, if the assessee himself or herself has taken a loan for further their education, or any dependent of assessee is undergoing some higher education, and for that purposes a loan has been taken by the assessee, the person, and the person is paying the EMIs. In that case, without any upper limit, any amount of interest that has been paid can be taken as deduction. And if the person is making a donation, depending on the nature of the institute, 50% or 100% of the donation can be taken as deduction. In most of the cases, charitable organization give you 50% of deduction. Certain funds which are started by central government, for example, PM Cares Fund, that was started for COVID relief, or Chief Minister National Disaster Fund, or Army Fund, all those funds usually have 100% deduction criteria. Now, this is the beginning of the year. Therefore, selection of the tax regime and declaration of tax saving investment becomes very much necessary in this period. Now, you have to keep one thing in mind: from this year onwards, the new tax regime becomes the default tax regime. Till last year, the old tax regime was the default tax regime, but from this year onwards, the new tax regime becomes default. Therefore, if you are not actively selecting older tax regime and submitting and declaring all the investment that you are going to do during this year, the old tax regime will never be considered for computing of the taxes and tax withdrawals. New tax regime will be considered for income tax calculation and tax withheld, right? So just keep this thing in mind that since this is the beginning of the year, you have to actively select whichever regime is beneficial for you, and you need to submit or state what are the investment options that you are going to exercise during the year. Now, let's try to understand and see the difference between the new tax regime and the old tax regime. New tax regime is, as per our experience, is not that beneficial for us because there is no deduction allowed to you for many tax saving investment. However, certain changes has been made in this year's budget of 2023, which made the new tax regime a little bit more competitive, right? Let's take a look at the changes that were made in the budget. Firstly, the new tax regime has been made the default tax regime. That is, if you are not going ahead and selecting the old tax regime actively, your tax will be computed and withheld according to the new tax regime. Under the new tax regime, now you will get a benefit of standard deduction, that is a straight away deduction of 50,000 rupees. Under the new tax regime, the slab rates has been changed. So previously, the income increase of 2.5 lakh rupees, the income used to change, the rate of tax used to change. Now, in income increase of 3 lakh rupees, the rate of income will be changed. Now, I am exclusively talking about pre budget and post budget new tax regime, right? So, after the budget, if your income is between 0 to 3 lakh rupees, the rate of tax is nil. From 3 to 6 lakh rupees, the rate of tax is 5%. From 6 to 9, it is 10. From 9 to 12 lakh rupees of income, the rate of tax is 15%. From 12 lakhs to 15 lakh rupees of income, the rate of tax is 20%. And beyond 15 lakhs, it is taxed at 30%. Excuse me. Furthermore, under the new tax regime, a rebate of Section 87A. The rebate of Section 87A has been increased from 5 lakh rupees to 7 lakh rupees. That is, if your income is not crossing 7 lakh rupees and you are opting for new tax regime, in that case, you are not required to pay any taxes, right? But for that, you have to opt in for new tax regime, and your income under the new tax regime should not be crossing 7 lakh rupees. This has been given to you wide increase of uh, change of tax for 87A relief from 12,500 to 25,000 rupees. Further, if your income is marginally over 7 lakh rupees, in that case, marginal relief will also be given to you. Let's try to understand with an example. In a nutshell, if your income is coming to 7 lakh 5,000 rupees, right, then you are supposed to pay the taxes on entire that amount, which does not seem very fair because your income just got a little bit over 7 lakh rupees, and up to 7 lakh rupees you are not supposed to pay any taxes. But just because your income has crossed 7 lakh rupees by a little margin, you are going to pay 26,000 rupees of taxes. Now that does not seem very fair. To alleviate this situation, marginal relief has been given under the new tax regime. Under this, if your income is marginally over 7 lakh rupees, the government is going to collect that additional amount as income taxes, and you are not supposed to pay taxes on the entire thing. So in this scenario, if your income is 7 lakh 5,000 rupees, government is going to collect 5,000 rupees as taxes plus education cess from you, and you are going to get to keep the remaining amount bu- as tax paid income. Further, under the new tax regime, higher surcharge rate has been removed. So, as you know, there are four rates of surcharge applicable: 10%, 15%, 25%, and 37%. Now, under the new tax regime, this 37% of surcharge rate has been abolished, and now 25% is the maximum amount of surcharge. Now, let's try to understand whether the new tax regime is beneficial for you with an example. Over here, we have assumed a salary income of 16 lakh rupees. Now, under the old tax regime, standard deduction is given, and before the budget, there is no standard deduction, and after the budget, there is standard deduction, right? So, after standard deduction, my income becomes 15 lakh 50,000 rupees under the old tax regime and post budget new tax regime. Now, let's assume I am paying a home loan interest of 2 lakh rupees. I am making the investment under ATC maximum 1 lakh 50,000 rupees. I am making an investment under ATD 50,000 rupees. I am making an NPS contribution on my own, and all these things together, I am getting a deduction of 4 lakh rupees, right? Now, I am making a overall contribution, additional contribution through my employer in NPS, right? Let's assume that amount is 50,000 rupees. So, under the old tax regime, I will get the deduction of that. In the new tax regime, which was present till this budget, I could only have gotten the deduction for National Pension Scheme contribution through my employer, which would have made my taxable income 15 lakh 50,000 rupees. And after the budget, this amount of deduction is still available for me. So my total taxable income is coming to 15 lakh rupees. Now, if we look at the taxable income computation under the old tax regime, my taxable income is coming to 10 lakh 50,000 rupees. And based on the slab rates, that is from 0 to 2 lakh 50,000 rupees, it is nil. From 2 lakh 50 to 5 lakh rupees, it is 5%. From 5 to 10 lakh rupees, it is 20%. And beyond that, it is 30%. After all this computation, my income tax under the old tax regime is coming to 1 lakh 27,000 rupees. And if I add in the education cess, my total tax payable will be coming to 1 lakh 32,600 rupees. Now, if I look at the pre-budget new tax regime, in that case, we will see there is a rate of tax increase of 5% in income increase of 2.5 lakh rupees. And using that computation, my total income tax is coming to 2 lakh 2,500 rupees. And if I add in the education cess, total my tax payable is coming to 2 lakh 10,600 rupees. Now, if we look at the scenario, after all the amendments that has been made in this budget, my slab rates are from 0 to 3 lakh rupees, it's nil, therefore it is no taxes. From 3 lakh rupees to 6 lakh rupees, the rate of tax is 5%, which will give me 15,000 rupees of tax. From 6 to 9 lakh rupees, it is 10%, which will give me 30,000 rupees of tax. From 9 lakh to 12 lakh rupees, the rate of tax is 15%, which will give me 45,000 rupees of taxes. And from 12 to 15 lakh rupees, the rate of tax is 20%, which will give me a tax of 60,000 rupees. In total, my total income tax will be 1 lakh 50,000 rupees. Now, if I add in education cess, I will be left with a total tax payable of 1 lakh 50,000 rupees. Now, if we look at this scenario side by side, I can still see the old tax regime is still a bit more beneficial for me. However, if we look at the scenario with with the context of this year's budget, we can see that the gap that was huge before the budget has been come down by a great extent. right? It has come down by almost 20. Now the gap between these two regimes are 24,000 rupees only. Previously, it was almost 90,000 rupees, right? Therefore, in the coming year, if the government can add certain more benefit under the new tax regime will become much more beneficial for you. Now we are at the end of our session. Now, if you have any question, we are going to take up those. Right. The question is, what is the status for rented property? Right. I assume this is the question for home loan. Now, if you have taken a home loan to purchase a property which has been let out, then there is no bar on the claim of interest. However, the loss from the house property will be limited to 2 lakh rupees only. Let's try to understand with this with an example. Let's assume you are getting a rent of 4 lakh rupees, right? You are getting a rent of 4 lakh rupees. Now, from that 4 lakh rupees, 30% standard deduction will be given, which will give you a rental income of 2 lakh 80,000 rupees. And if you are paying 4 lakh rupees as interest, in that case, the entire 4 lakh rupees will be deducted and you will be left with a loss of 1 lakh 20,000 rupees. Now, this 1 lakh 20,000 rupees will be used to set off any other income, salary income, for example. If, however, the amount of interest is coming to, let's say, 5 lakh rupees, the loss amount will be 2 lakh 20,000 rupees. In this case, 2 lakh rupees of loss will be set off against any other head of income, and remaining 20,000 loss will be carried forward for 8 years. Now, investment made for pension scheme. Yes, if you are making investment for pension scheme, it will be coming under 80C. Uh, if I opted for new tax regime this year, next year can I change back to old tax regime? Absolutely. If your income is coming from salary, capital gains, etc., etc., and it is not consisting of business income, in that case, you can switch between the tax regime each and every year. Right. If you have any question, please drop them in the chat box. Well, 80 ggc is if you are making contribution towards any political party. If you are making contribution towards political party, then it is 100% deductible provided you get a receipt for that, because in the income tax return you need to fill in certain details of that political party. For example, its name, its PAN number, address, etc., etc. Now, you can get a 100% deduction if you are making donation in political party, provided you have a receipt for it and those receipt has these details on it. Right. Interest earned on savings bank account interest is not tax exempted. However, there is a deduction allowed on such interest amount, that is 10,000 rupees. So what will happen? You are supposed to declare the entire amount of savings bank account interest in your tax return, and upon offering such income, you will be given a deduction maximum up to 10,000 rupees. If the interest amount earned is lesser than 10,000 rupees, then entire amount will be given to you as deduction. If the interest earned is more than 10,000 rupees, say 12,000 rupees or 15,000 rupees, the 10,000 rupees of deduction will be given to you. And remaining 5,000 rupees will be taxed in your hand. The amount paid to CM Relief Fund. The amount paid to CM Relief Fund will be deducted from taxable income. It will not be reduced from the amount of tax that you are supposed to pay. Right. Uh, Salary for new tax regime. All right. So in this case, let me share a link with you. Please use this calculator to see for yourself which tax regime is going to be more beneficial for you. Okay. So long-term capital gains, it actually depends upon the asset that you are holding. Uh, if it is share, India listed share, in that case, the holding period is more than 12 months to be considered as long-term capital asset, and any gain that you are getting, that will be taken as long-term capital gains. The rate of tax for such asset is 10% beyond 1 lakh rupees of gain. All right. Below 60 years, FDSB interest exemptions. Again, the if your age is below 60 years, then FD interest there is no deduction. Savings bank account there is a deduction of 10,000 rupees. RD interest is taxable fully. If you are more than that, then the limit is extended to 50,000 rupees, and it gets the FD interest as well as savings bank account interest are covered for this. Right. We have another couple of minutes our hand. Shujata, please use the tax calculator and you will see for yourself which regime is beneficial for you. Well, Ganeshan, as I have explained, the amount paid to CM Relief Fund will be deductible from taxable income, not from the tax itself. 80TTP is only allowed under the old tax regime. It has lost its relevance under the new tax regime. Well, Arun Kumar, you cannot claim for 2 years LTA in one single year. That is not permissible. You are only supposed to claim 1 year travel from that years, and whatever amount is given to you as LTA component in your salary till that amount, or the actual expenditure, whichever is lesser, that will be given to you as deduction. In case of joint property and loan is under both the spouses' name, in that case, both of the spouse can claim the interest component in its equality in their income tax return. Now, we are currently at our end of our session. I would really like to extend my thanks for all of you who has been a part of this session. I hope if you had any doubts regarding taxation and the tax regime, I really do hope those have been answered. Thanks for joining with us. Have a great day.